Hello world, welcome to Farm the Market. On the Stock Trading Journal series, I share with you some of my trades. I do not claim to have the quote-unquote epic strategy that beats the market every time. I just hope it's a good exercise for me, where I get to analyze some of my trades deeply by explaining them to you, and hopefully for you, by looking step by step at examples of real trades, you might find interesting some of the techniques or adjustments I use on my trades, and this might help you in your journey to develop your own trading skills. This time we will take a look into a trade on American Airlines. Let's get started. I would like to talk about the general market conditions first. On December 4th, 2021, I posted a video titled "VIX Contango Streak Broken." The general idea was that the VIX term structure had broken a very long contango streak. If you want more information about why that is relevant, I invite you to watch that video. You can find the link in the upper right corner. Since then, the VIX term structure has been more erratic, switching back and forth between contango and backwardation frequently. As I often mention, this by itself is not a signal to go long or short the market, but in my opinion it's a relevant piece of information that tells us a lot about the general market conditions. Not just by the switch itself, but also how often it happens and for how long. Actually, I also posted a video titled "When to Play Defense" that touches on this subject. You can find the link in the upper right corner. I think it's worth your time. Since that last video was posted, the VIX term structure went into backwardation once again on February 17, and as of March 4th, that streak is still held. That means 12 straight trading days with the VIX term structure in backwardation. That is something to consider seriously. As you can see on this table, that doesn't happen often. In a window of almost 10 years before the last long contango streak was broken on December 2021, a backwardation streak of more than 10 days happens less than 15% of the time. Okay, what does all that mean? The short answer is that in my opinion, the market conditions continue to deteriorate. The knee-jerk reaction of buying the dip that worked great in 2020 and during some periods of 2021 has not been appropriate for a while, and less so under current market conditions. In the "When to Play Defense" video, I focused only on reducing long exposure to the market, but for this video I would like to talk about the other side of the coin, opportunities to short the market. Right off the bat, I want to say that in my opinion, shorting the market is much harder than going long. Remember, you can do great in the market by just going long and waiting on the sidelines when the conditions are not in your favor. I am not a fund manager, and I assume none of you are either, so going into cash is always a viable option for as long as it's needed. Having said that, I'm always trying to improve my trading skill set, and shorting is probably my weakest link. So, whenever I decide to short, I want to have as many variables as possible in my favor. Circling back to the backwardation theme, I'm more inclined to look for shorting opportunities within this environment. Okay, after that long introduction, let's get into the trade itself. The topic du jour for a while has been inflation. Commodities have been going up like crazy, and if we add to the mix the recent conflict in Ukraine, this has only been more fuel to the fire. And talking about fuel, energy prices have been among the most affected by the current conditions. Oil in particular has been blasting higher, as we can see on this chart. Within this context, in my opinion, one of the most affected sectors would be airlines. So, I have been looking for opportunities to short this sector for a while. My first approach was to look at the JETS ETF. For obvious reasons, it had been moving contrary to oil prices. Although I had a good quote-unquote story for a short trade, I wanted to confirm the entry with technicals. The Jets ETF held a support around 19.50 a few times since December. And finally, on March 4th, the support was broken during the day, and towards the end of the session it was clear the close would be way below it. Although Jets was my initial reference, I was much more inclined to trade a stock within the sector. In this case, I decided to use American Airlines. The main reason is the options market. If I eventually decided to add another layer to the trade with options, in my experience, the Jets ETF options market is less efficient. Also, as you can see on this chart, the technical pattern looked much better on AAL compared to Jets. The pattern was contracting from left to right with shorter moves in both time and percentage change. You might think this sounds a lot like cherry picking, since the correlation is high between Jets and American Airlines, and even more so when they are going down. But I just felt more comfortable framing the trade like this. So I decided to sell 250 shares of American Airlines. As I mentioned before, shorting is not my strong suit, so I usually use tighter stop losses. In this case, I decided to set my stop loss at 3% and was aiming for a 2.5 risk-reward ratio. Therefore, the profit target was around 7.5%. I wasn't thrilled to open the trade on a Friday, but that was the day the technicals gave me a good signal, so it was time to act. Monday comes by and the markets are taking a serious beating. As the price of American Airlines gets closer to 13.43, I decide to reduce the size of the order to half and move the stop loss to the break-even point. About an hour later, the trade is executed. I book some profits, and I'm left with just half the position and a quote-unquote guaranteed winning trade. Although now the trade is in pretty much a win-win situation, I get a bit anxious to do more. Towards the session close, I start to analyze alternatives to add a layer with options into the trade. I'm considering selling a put, or just protecting the position against a gap up tomorrow by buying a call, or both. In the end, I just decide to sell the position completely and take the profit. Overall, the trade was great. In just one day, I generated almost a 10% return. Playing Monday morning quarterback, although the trade turned out great profit-wise, execution wasn't the best towards the end. The end of the session is very time sensitive, and while I was quote-unquote playing with the option simulator to add another layer to the trade, I missed an alert on another position. It wasn't a big deal return-wise. My delayed response just shaved off about 0.50% of the profit from the other position. All this might sound silly to you. You might think, oh come on, what's the big deal if both trades were profitable? But the bottom line is that it is not a good practice at all. I got lucky this time, but eventually that will cost me. I tend to sometimes overthink trades, especially on shorts, and that happened again today. In other words, I must remember to keep it simple, stupid. This video might seem too long for a one-day trade, but I hope you found informative my view around the market conditions, the setup, my train of thought regarding shorts, the adjustments, and the conclusions about the management of the trade. Until next time. I hope you found this video interesting. Please remember to like and subscribe. Thanks for your time.